Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
All right. Proverbs 16:1 says, we can make our own plans, but the Lord gives the right answer. You know, wouldn't it be great if we knew what the Lord desired for our retirement? On today's program, we're going to discuss 13 things you should be doing to prepare for retirement, whether you're approaching 65 or only 25. Hi, I'm Certified Kingdom Advisor Mark Trice, and I want to welcome you to the Spend Life Well Show, where we apply biblical wisdom to your financial journey. I'm joined in the studio today by my co-host and financial person here, Jesse Hamilton.
Hey, how's it going?
Good morning, Jesse. We're glad
Good
that
morning.
you've chosen to join all of us here on the program this morning. Grab a cup of coffee. I've got mine all
So do
ready
I.
to go. It's all nice and hot. So have a sit down with us and talk about what the Bible has to say about finances. Folks, you can also text us or call us at 254-282-0495. That's 254-282-0495. Hey, Jesse, if people want to send us a message that's not via text or email, how do they do that?
Yeah, feel free to send us an email at radio@spendlifewell.com. We would love to hear from you. We will respond to you either on the show or within 24 hours. And we may even choose your question to be pulled for our mailbag on an upcoming show. But that's radio@spendlifewell.com for email. And if you want to call or text us, 254-282-0495.
So, Jesse, a lot of stuff going on in the news this week. We're going to get into that in a little bit. But how's your week been?
It's been very good. We have been busy, but life is treating me well. A lot going on. How are you doing?
Yeah, we actually had a day where it wasn't 100 degrees.
Yes.
Isn't that awesome?
I sat out on my back porch last night with my wife and my dog running around, and I was like, I'm not miserable.
Well, how is Bean doing? I know he had a little thing where he got into some trash or
Yeah,
something.
he had a little incident, a little digestion intestine problem, but he is doing much better now, and the scare is done. So
all right,
thankful for that.
He worked things out, and
Yes.
you didn't have to spend thousands upon thousands of dollars to save your fur baby. That's great. Well, this has been a kind of an eventful week. We've been coming off a lot of financial news in the last few weeks, and we know about inflation. We know about interest rates rising and so forth. And supposedly, according to the president, we had zero inflation for the month of July. That's awesome. Nice job, Mr. President. And if you've never listened to our show, you know that we are being somewhat facetious right now. It's satirical, I guess, because clearly we still have inflation in the United States. And one of the biggest areas that's jumping up on inflation is the cost of food, which hits everyone because we all have to eat. And so are we in a recession? We've talked about this in previous weeks. Well, it's kind of a technical thing. We'll get into that a little bit. But Jesse, I noticed in the news this week was really about home prices. We're still having record home prices. And that is causing, in conjunction with rising interest rates, that's causing it folks to have more trouble being able to afford and to qualify for a mortgage.
Yes, it is. I saw that it was more expensive to buy a home in June than it has been in any month for the last 3 decades. So that's a record high home prices. And, when you combine that with the mortgage rates, it is extremely difficult to buy a home.
I did a lot of research when I was working on some graduate degrees and stuff like that. And one of my master's thesis was actually on home affordability. I think I've said this before. I've not tried to toot my own horn, but I kind of know what they're talking about. And one of the main measures, and this is put out by the National Association of Realtors, their Housing Affordability Index, which factors in family incomes, mortgage rates, sales price for existing single-family homes, that fell to 98.5 in June. Now, that's the lowest level since June of 1989 when the index stood at 98.3. And Jesse, you weren't around then, but June of 1989 was kind of, the economy was slowing a little bit, and we were about to go into a recession in the early 90s. And so this, even though, existing home sales have declined for 5 straight months, what else happened during the 5 straight months there, Jesse?
We had home prices steadily climbing, and the sharpest erosion of affordability. You've already mentioned that.
Yeah.
But
And interest rates rose.
Yeah, interest rates are going up and up and up, and we're reading headlines about that all the time.
And this really it hits hard for first-time home buyers. Because for those of you that are listening in the Central Texas area, you know that house prices have skyrocketed in the last several years. And part of that was due, in fact, that we had just had incredibly historically low interest rates. So it made the monthly mortgage payment on a home a lot more affordable for folks. So people could actually afford more home. That created more demand, prices going up on those houses. But really, mortgage rates have hit a 13-year high in June. That's a big news. So
pretty big news, yeah.
Yeah. So we want to be we are concerned about that. And so, at the end of 2021, we saw the average 30-year mortgage rate about 3.1%. I know I've talked to people that refied and had their rates in the twos.
Wow.
But I forgot to check exactly what it was this week, Jesse. Those mortgage rates. I'm going to do a quick Google search while you kind of talk to people about the market in general for houses.
But at 5.22%, Mark's going to get us an even more accurate figure on that. That just makes a significant difference in the monthly payment, which is what people really feel as a part of their budgets. So
That's right. Now this is going to depend on where you are in the country. I'm gonna put in here a typical Austin zip code, and we have a general category here. I hope it's not going to make me apply for a loan here to get this rate, because I maybe not be looking at. Yeah, of course it's going to do that.
There is an interesting note here, Mark. The 3 strongest price growths during the pandemic were, I don't know why, but the top 3 were Boise, Idaho, Austin, Texas, and Phoenix.
Wow. Yeah, well, everybody wants to come to Austin.
Yeah.
Okay, so we're seeing average 30-year fixed rate right around 5.125. So they've actually come down just a shade, and that's for a typical strong credit type mortgage.
Right.
And so they're dropping a little bit, but we'll just have to see if that continues. That trend continues. I don't see why that does continue, especially if the Federal Reserve is going to raise interest rates. So, economists are expecting that home prices that growth to slow significantly by 2023. And so we'll see if it begins to level off. I know when we had the housing crisis around the country in 07, 08, in that time frame, the Austin, Texas market really didn't cool off that much. And I was surprised about that. I know I was buying a home around that time in the West Austin area, and the rates were still pretty low and stuff, and demand was still pretty high. So I don't think that Austin suffered that. I don't know if we'll see that type of thing, because we have so many employers that are moving their headquarters, that are expanding in the Austin area. I don't know that we'll have that much cooling, but I do think we'll see that growth begin to slow. I know I've talked to a few realtors, and you may have too, Jesse, that kind of said, things are still moving in the housing market, but they're, slowing a little bit. It might take, rather as before, we might have had several offers on the first day that the home was listed. It might be taking a week to get those same offers and stuff like that. So
I actually saw my realtor at church this Sunday and talked to them about kind of the current state of my neighborhood, because they obviously helped me buy my house in my current neighborhood. And they said that they have, I forget the number that this person said, but I want to say 6 new builds that are listed right now that they're trying to sell, versus a year and a half, 2 years ago, those houses would have been bought before they were even finished.
Well, I know some builders like D.R. Horton or Pulte, and this is coming from the Wall Street Journal, reported in July that their cancellation rates rose in the quarter ending on June 30 from a year earlier. But they said they still got a line of people that are wanting to purchase those homes where people canceled out. But to give you an idea, according to the National Association of Realtors, when we talk about affordability dropping, that means that the typical average home buyer with the typical average interest rate, assuming that they're putting 20% down, that typical mortgage payment rose to an average of $1,944 a month. That's just principal and interest only. And that was up from about $1,200 in January. And
wow. That's pretty big change.
Even less in June of 2021. And so that's a big difference. When you think about, trying to make your monthly mortgage payment and you go up $700 in the span of 6 months, if you didn't buy last year, that's a big deal. And affordability has absolutely changed. And that just means that there's fewer buyers out there, especially first-time home buyers out there that really can afford the average price house. So anyway,
do you think that people are too late if they're trying to buy their first home?
I don't think so. We should never say, well, we're out of the market now.
Right.
Keep saving. You need to save for that down payment. Don't go into these situations where you get 100% financing. That's dangerous. Those are typically in new construction neighborhoods and things. And as soon as you sign on the dotted line, you'll quickly find out that, in fact, that house is really worth less than you paid for it. I know a lot of people have made good money like that, doing 100% down. I think that's risky. I think the Bible tells us that we should exude caution when it comes to having debt, and being underwater on your house is not a good place to be. So anyway, I think that, we just have to watch this. And if you're a first-time home buyer and you're trying to figure out how to buy that first home, keep plugging away at the fundamentals. That is, keep your credit score good, pay off your debts, save for that down payment, and you will find that house soon enough. So, we'll certainly be prayerful about that, and the economy doesn't cool off like we think it might be. So, Jesse, moving on here from home affordability, do we think that the market is is the economy is in a recession?
Well, there's so many different factors to look at. The technical textbook definition that people have used for a long time is 2 quarters of negative GDP growth. And we have that. The data is out there. You can look it up. We have a chart that we've used in our monthly webinar update that shows 2 quarters in a row. So
a lot of people think we're in a recession, right? I mean, but this one's kind of different.
There's a lot more to it.
There's a lot more. It's a lot more complicated. That I read an article this week, and it basically said that the stock market has predicted 1 out of the last 0 recession. And no one really knows what's being priced into the stock market at any one given moment. But a lot of the people do think we're in a recession. The complicated stuff around this, though, is week before last, we had the July jobs report. We had over 500,000 jobs in the last monthly reading.
Unemployment generally marks a recession, doesn't it?
Yeah, you see rising unemployment, fewer jobs out there, but we're not seeing that. But a lot of it, well, let's get into that.
Okay.
Inflation is high, right? And we know there's a lot of mixed signals. Employment is strong, inflation is high. But if we see that, employment continues to pick up, that's going to create more inflation. So I don't think that this is really normal. Because, you got the unemployment rate. It's now lower than it's been in all but 5% of the readings since 1948. So that means that these things are moving very quickly. But we have to remember that this time it's different because we had a self-induced recession with the pandemic. So the labor market... Go ahead.
It says it shot up to 14.7%, but that was very brief. People were staying home, losing their jobs in an instant, and now it's back down to 3.5.
Yeah. So when we come back from the break, we will talk about this a little bit more and get into our main topic of the day. And that is the 13 things that folks that are thinking about retirement ever need to be doing and talking well about with their advisor. Folks, you've been listening to the Spend Life Well show. I'm Certified Kingdom Advisor Mark Trice. We'll be back in just a moment, and you can send us your texts or questions at 254-282-0495. We'll be right back. Welcome back, folks. You're listening to the Spend Life Well show, where we apply biblical wisdom to your financial journey. We've been talking here today about the economy and housing affordability and so forth. And we just talking about how this, if it's a recession, it's a different type of recession. Some economists say it's not a recession. I think one of the things that's kind of complicating, Jesse, is that the labor participation rate is still not above where it was before the pandemic.
Okay.
And that could be we could explain that shortfall for a number of different reasons. It could be retiring baby boomers. Productivity numbers are also down. And so people are changing jobs. Perhaps some of that's where people just have one job, they've got 3 jobs. And so the job report that came out was actually good news, but it was also bad news. And the bad news is that could this be spelling some weakness in the economy? Is that going to cause inflation to continue to go up?
Yeah, Mark, I was listening to an economic update this week from one of our favorite providers. But this person was talking about how
You're talking about Kingdom Advisors?
It's a partner of Kingdom Advisors, but I won't name what company it was from.
Yeah.
So this person was talking about the gig economy and self-employed people who don't report on top of these numbers. And so there's so much more going on than we actually know about.
So it kind of reminds me of, and I'm dating myself here, Jesse. I used to watch The Office sitcom.
I love The Office.
And there was a scene where Michael Scott, who's the manager of the Dunder Mifflin Paper Company in Scranton, Pennsylvania, was going to interview for a job with his boss or promotion, and the boss asked him the typical questions about themselves. What do you think is your greatest strength as a manager? And of course, Michael Scott, in his buffoon type way, basically says, "Well, why don't I tell you what my greatest weaknesses are?" And he goes through is like, I work too hard, I care too much, and sometimes I get too invested in my job.
So are you saying that's the economy today?
It kind of is. We're not trying to pick on him or anything, but that's why some people are concerned about the hot labor market. And having an inflation this high. It's not great. It's kind of a catch-22 of the current economic environment when you think about that scene from The Office. But that could keep inflation at uncomfortably high levels. In order for the Federal Reserve to cool this labor market inflation, we might have to go into recession. And that's going to leave a lot of people unhappy. So it's just kind of a weird situation. It's a weird situation. And as we always tell listeners, is don't fret that. Don't worry about that. There's just lots of contradictions all around. But what's new? What's new? So Jesse, how's the market doing this week?
Well, we're actually in the middle of a little bit of a rebound. So that doesn't mean to say that the market is healthy by any means, but I'll just give you a few stats if that's all right.
Yeah.
So the Russell 2000 index is one that we follow, and that index from its peak is still down 17.89%. If you look at a chart, you'll see a recent rise in the prices there, but it's just something that we're watching every day and following closely. So let's talk about the S&P 500, everybody's favorite large cap index of the 500 largest companies in America. That index is having quite a rally, but is it a bear market rally? We don't know if it's going to test a new low, or we can't tell what the future holds, but from its peak, it's still down 10.63%.
Okay. All right.
Yeah. So as well as the NASDAQ is the tech heavy sector, or the tech-heavy index that we follow, and it's had quite a dramatic change since its peak. But even with the current rally, we're still down 19.23 from the high.
And pundits have been saying that the NASDAQ is no longer in a bear market because we've actually come up 20% off of the bottom. And that is true, but we're still 19% down from its high. There's, why is the stock market bouncing this summer? And there's a lot of explanation. I think a lot of enthusiasm right now in the markets is betting on an assumption that the Federal Reserve is going to pivot. They're going to go away from raising interest rates to cutting rates. I think that's crazy. I don't think that the Fed has done enough. But then again, I'm not the Fed. That's way above my pay grade. So that's one reason. Another reason is that oil prices are down a lot, about 25%. It just depends on which talking head you listen to on television or radio about what's going on. Is it because China's ending the lockdowns? Is it because the labor market is staying strong? Is it because companies they're coming in a little bit better than expected? Which that's a whole nother story, Jesse.
Mm-hmm.
People forecast and give forward guidance on their earnings, and then if they beat them, then that's a big positive thing. Well, companies have figured it out, and they're going to basically give a little bit more dismal performance expectations, and when they beat it, it's a big party, right? And that's not really true, really revealing as to what's really going on in the economy.
It's like when you go to gym class when you're in school and they do your like beginning of the class test and you don't try very hard, so that at the end of the class you can show how much you've improved.
That's what it makes. Jesse, I would never do that.
I'm not saying I did that. I'm just saying that was a lot of people
kind of brought that up. It's kind of concerning that you might game the system on gym class. Oh, come on! For me, I'm the opposite. I would just I don't care. I'm going to try to be the best in the class at the beginning and at the end. So that's all that mattered to me, is being the winner. So we'll have to talk offline about that, Jesse. I know you go to the gym every once in a while. So anyway,
the last index though, before we move on, Mark.
Oh yeah, sorry.
Is the long-term Treasury index.
Yeah.
That index, believe it or not, Mark, is still down 25.68% from its high. Can you believe that?
Yeah. 25.6%. Now this might be impact. The Federal Reserve is still talking about shrinking its balance sheet and bringing down the money supply. This is going to impact bonds. They've got to unwind all the bonds that they purchase, and that's what's the size of that portfolio? $9 trillion.
Yeah, it's several. 9 trillion sounds about right.
So they're letting some of those mortgage and treasury bonds mature without replacing them with new bonds, and they're just kind of gradually rolling them off. But they haven't been real serious about that, and so that might impact the bond market as well. So there's so many things going back and forth with the economy. We really can't predict what's going to happen. All we can do is look at the data and where it's going. We'll keep you apprised of that here on the Spend Life Well show. So let's jump into our main topic for today. I don't want to keep some of our listenings on hold. It's like with so many people thinking about retirement, whether you're 25 or 65, moving into that period or preparing for that period can actually be quite daunting. So we've got a little process here, 13 different items that you need to do to be prepared for retirement. And the first one is you really need to meet with a professional financial advisor to get assistance on this. I'm a financial advisor. Jesse does support in our office. He does a lot of our client relations and things. And so we can visit with you about these things to help you prepare that roadmap for retirement. So that's probably the first step, folks. You should not do this alone. You should access the resources that are available to you. We always encourage our listeners to seek out a certified Kingdom advisor in their area. You can just simply go to kingdomadvisors.com and put in your zip code, and they'll pull up 3 or 4 that are within a short distance of your geographic area. For those of you that listen during the weekday to the MoneyWise Live program, of which we are sponsors, you'll hear them talk about that quite a bit. But that's kingdomadvisors.com, and you can go and find a certified Kingdom Advisor for that. We think those are the best because they've been trained in biblical wisdom about different financial systems and what the Bible has to say about these things. And they're also really smart financial advisors in general. But they love the Lord, and they have committed their careers to serving clients from that biblical perspective. So this is really
so Mark,
yeah.
there are people out there that might say, I'm going to retire in 10 or 15 years. And then there are people who say, I just collected my last paycheck. Who's right here?
Who's right?
In terms of their timing.
Oh, well, 10 years is better than yesterday, right? And that happens a lot. We have people that will come in and sit down, and they're all excited and stuff, and it's like, I want to make sure I've got enough to retire. And the first question that I might ask is simply, when do you want to retire? And I can't tell you the number of times, and it's been many, many times. They look at me with a straight face and they say, well, I just gave my notice. And you're like, okay. We try to encourage people, so we don't sit there and say, what were you thinking?
You don't show up to a realtor's office with your moving truck.
That's right. That's just not the way it works. And preparing for retirement is the same way. You got to prepare for it in advance. That's why the best time to start preparing for retirement is when you enter the workforce. So you get your first job, you need to be thinking about the future. But more importantly, if you're near the retirement zone, a retirement end zone, if you will, since we're coming up on football season.
Oh yeah.
You want to sit and meet with an advisor. Most advisors will sit and meet with you on a complimentary basis the first time. You get to know that person to see if they might be able to be a good fit, and they'll also see how they can help you. So that's one thing, is get some help. Right. The second thing that we think that is real important is you need to determine how Social Security benefits are going to play into your retirement income stream.
Mm-hmm.
Jesse, how many different ways can a married couple file for Social Security? Do you remember how many?
I believe it's over 20,000.
That's right. Over 22,000 different ways to file for Social Security if you're a married couple. Even a few less if you're divorced or have been married for more 10 years and divorced, or a widow. So
a really cool tool that we use in our office is actually a software. That's a program that we use. It uses a little bit of artificial intelligence and different charts and numbers to determine and help us make the decision to help people with that, right?
Yeah, because a lot of people, Jesse, think that there might be 3 or 4 different ways to draw your Social Security. And one of the big mistakes that people make is, especially if they're still working, they will draw their Social Security at 62. And there's a lot of rational and irrational reasons that we hear from people about when they're drawing their Social Security. I can't tell you the number of fellas that are out there that are convinced that they're going to die soon, and they must start drawing Social Security because they don't want to die and have missed out on their Social Security benefits that they worked so long and paid into. And I understand that. I understand that rationale. But unless you're having regular conversations with the Lord and He's told you you will come home in 3 days and 4 hours and 27 minutes, we don't know when we're going to pass away. We have to act as if we're going to live a long time. And maximizing Social Security, and this is one of the software tools that we use, helps us do that. It's analyzing all 22,000 different ways to draw that Social Security and how to file. Because I think people don't realize the importance of Social Security when it comes to their retirement income. What you're doing now, by earning is helping to build that potential monthly benefit.
Mm-hmm.
And you need to know what that is. And we've got the tools to help you do that. Social Security analysis has become a very important part of retirement income planning, because for many people, it might make up 40, 50% of their retirement income. And so making sure that you maximize that and get every dollar that you are entitled is so important. Jesse, do you remember? I know a lot of people have questions about, Social Security going to run out of money, and this is not a good thing. I want to draw it as soon as I can.
Mm-hmm.
And I'll go back to the illustration that we had with the guys, right? They're worried they know when they're going to die. But I have yet to meet anyone as they're lowering you into your casket and closing the lid that have a look that they're upset that they didn't get all their Social Security that they were supposed to get. That's not how it works. Social Security is not, you haven't been paying into a little fund that's labeled for Jesse Hamilton.
Yeah.
It's into a big trust fund, and you're entitled to a certain amount, but many of you will never get the amount of money that you put into it out. Many of you will get a whole lot more than what you put into it. So you need to decide when and how to do that. That's the linchpin, if you will, to maximizing income in retirement, is knowing how to maximize your Social Security benefits and know when to take them. It's so critical, so critical. So Jesse, those first 2 points there: meet with an advisor, get some guidance, decide and work with your advisor to determine when you should take Social Security, how long should you delay, how does that factor into my income stream. Those are the first 2 of our 13. And when we come back in our final segment on today's program, we will get into the nitty-gritty of things and talk about all the other things you need to be doing to think about retirement. Folks, you're listening to the Spend Life Well Show. We'll be right back.
All right, everybody, welcome back to the Spend Life Well Show. I'm Jesse Hamilton, and I'm joined by Mark Trice, as always. If you want to give us a call or a text at 254-282-0495, we'd love to hear from you. But Mark, let's jump back into our discussion here of what people need to do, what they need to cover as they approach retirement. Our next topic here is kind of two-pronged approach here. Review their income and asset allocation mix. These are 2 crucial parts of your retirement plan.
Yeah, as you're looking at things, what income are you going to have coming into retirement? We talked a little bit about that when we were visiting about Social Security.
Mm-hmm.
But you also need to review your asset allocation mix. Now, what is that? That's just the pie chart of things that we own for retirement. It might be the funds that we own in our 401k. Are we taking on too much risk as we approach the retirement airport, to use an analogy for travel, right? So are we taking on too much risk? Does your portfolio say that you are rolling the dice and you put everything on black number 13? What does it say? Because when we get into retirement, the sequence of returns risk is a real issue.
Yeah, this is something that we share in a lot of our presentations when people ask kind of our philosophy on how we manage money. Sequence risk is just simply the timing of loss compared to when you take money out of a portfolio. And it's really important because a small loss only takes a small gain to get back to where you were. But a large loss takes an immensely larger loss to get back to where you were. Some numbers for context: about a 10% loss requires 11% to get back to where you were, right, Mark?
Mm-hmm.
And
That's
then,
right. And the illustration we sometimes use is a bucket.
mm-hmm.
And if you're watching online, I'm not going to do this in the studio because it would mess up our equipment. But if you're watching online, I'm holding up my Rose's Cafe drink from this morning, and when you start in retirement, you're poking a hole in the bucket because you're pulling money out, right?
Right.
But then when we have a market drawdown like we've had, we're poking another hole in the bucket. And you have two streams of drink here or water coming out of the bucket. That means it's draining the bucket faster. So when we have drawdowns, you're not only experiencing the drawdown of the markets, but you're also experiencing the drawdown of you're just simply spending money, right? And it magnifies the impacts. And that's why we talk about the sequence of return risk, because that's important. And a lot of people haven't planned for that. They have looked at, and this is kind of our fourth point here. They've looked at when it comes to income as a straight line depletion. In other words, they've got $1 million. They're going to spend 50,000 of it every year, and they don't account for market drawdowns because we've been ingrained, we've been trained in our society that the markets only go up. The markets only go up. And so this is not the case. We've seen this year. NASDAQ down over almost 20%. Bonds, the safe place, right? That's what we've been told.
The safe place.
Down almost 25%. So you have to be concerned about longevity risk. You have to be concerned about the loss of purchasing power because of inflation. You can't hide all your money in a mattress and expect it to last your entire lifetime. So you've got to look at that and look at a retirement income, your needs there, and know that it may have to last for 35 years or more. Jesse, I was doing a workshop one time for one of our local credit unions, and a fella came in afterwards to visit and so forth, and he was in his mid-90s. And he was explaining to me that he had spent more years of his lifetime in retirement than he actually spent in the workforce. And he had worked 35 years or so in the workforce, maybe 40, and another 40 in retirement. So your retirement may last a very long time. Just because your dad passed away at 68 and your older brother passed away at 67 does not mean that you're going to die at 69. Folks are living much, much longer, and we need to plan and make sure that we have an income to last over your entire potential lifetime. You know, in an ideal world, Jesse, that last check will bounce as they're closing your coffin, right?
Mm-hmm. Yeah.
But we're going to have, hopefully you'll have some left over. And that's just because you had cushion. And the Bible instructs us that we need margin in all areas of our lives. And financial margin is so important as well. So
true.
One other area that I think a lot of people don't think about is those major purchases, right?
So what are examples of those?
Well, a new car. Maybe we're wanting to downsize a house. We want to make those major purchases if you can while you're still employed.
The reasoning for that is because of the income stability, or why is it?
Income stability, and you don't want to have a major shock in your retirement income sources. Okay. I'll share the story. There was a situation one time that someone came in and after they retired and they wanted to buy a shiny new Cadillac. Well, and they wanted to pay cash. Well, that can take a big chunk out of your retirement savings. And so you should probably do those and try to have those debts paid off well before you actually retire.
Okay.
Now, you may need a new car here and there along the way, but if you can, make those big purchases prior to retiring. So what's our sixth one out of 13? What's that about? Medicare?
Yeah, Medicare. So people are going to need help signing up for Medicare. There's Part A, Part B. For those of you that are familiar with it, the initial enrollment period is 3 months prior to turning 65 and then 3 months following.
Including the month that you turn 65. So there's actually a 7-month window.
Mm-hmm.
But, if you're covered by a large group health plan at your work and you're continuing to work past 65, you should not have to sign up for Medicare. You're exempt, Medicare Part B. So
Despite what they may tell you.
yeah, a lot of people are uninformed about this. And we run into people all the time where they're paying Medicare Part B premiums and they're also paying their health insurance at work, and they didn't need the Part B. So the best thing, and this is why, if you find a good financial advisor, they're going to know these things and they're going to advise you. But I can't tell you the number of times, Jesse, that we're doing a seminar. And by the way, go to our website, spendlifewell.com, and you can find all the upcoming seminars. We do a market update, in-depth market update, the first Saturday of every month after the show. And then we also, starting in September, we'll pick up some of our topics. And I think the topic in September is going to be about healthcare in retirement.
Great.
But a lot of people are surprised when they hear that they never had to sign up for Medicare Part B because they were covered by their workplace retirement plan. So it's important that you look at those things, that you seek the help of a financial professional. We have a lot of experts in Austin that we refer folks to when it comes to selecting the right Medicare coverage and doing that. And that's so important there.
So what about Roth conversions, Mark?
That's well, these are always things that we hope that your financial advisor is talking with you about, because one of the ways to potentially reduce your future tax liability is to make your retirement investments tax-free. And so one of the things that we look at and we try to project forward with our clients is we want to look to the future and try to determine what might be your future tax liability, because there's this magic age that comes up for most people, and it's the age of 72. And that's when Uncle Sam says, I want my money back because you've been investing in these 401ks and these traditional IRAs that are tax deferred. And at age 72, you have something called a required minimum distribution.
Right.
And Jesse, in some cases, these required minimum distributions can be quite large.
They definitely sneak up on you if you're not prepared for them.
That's right. If you've got a $2 million sitting in a retirement plan 401k, and you hit that first year of required minimum distributions, that might be $80,000 that you have to pull out of that account, and you might not want that.
Mm-hmm.
So how do you minimize that? Well, one way to do that is to potentially convert some of your traditional IRA money or 401k money over to Roth IRAs. Now, this is a very complex calculation that needs to be done because you have to look at your tax liability. We want to make sure that we don't put people over into a different tax bracket or Medicare Part B premium bracket. So that's something that you can do. Jesse, in the interest of time, let's keep moving on. But
okay,
you also need to talk to your insurance professional to talk about your life insurance policies. Do you still need those when you retire? I mean, how much do you? There's different phases, right? As a young couple, you and your wife may only have a certain amount of life insurance, right? Because if something happened to you, you want to make sure that your wife's taken care of. But what happens if you have children? That changes.
Yeah.
So you need insurance is used in different ways throughout different phases of a life, and you need to make sure you're getting a review. A good financial advisor will help walk you through that, or if you have a good insurance agent that you work with for years, they can help you evaluate that as well. The question is, make sure they know you're not looking to buy more insurance. You're just trying to evaluate to make sure that what you have is sufficient to fill any holes that you might have. And then there's, typical questions. Are you still relying on your outside income? Are you in any type of significant debt? Are there any adult children that we need to take care of? And so that's important.
Right.
Jesse, what about long-term care? This is our 9th point.
So yeah, in doing research for this show, I read that 7 of 10 people will require long-term care.
Wow.
So that's quite that's more than the majority. That's most people. So it's just something we need to be talking about. There's lots of different ways to prepare for long-term care. There's traditional long-term care insurance, which has been around for a long time, right?
Right, it has, and the costs keep going up for that, of course.
Mm-hmm. And then there's some sort of a hybrid policy, which are getting popular nowadays. Those are asset-based long-term care solutions.
And those are situations where if you end up not using the long-term care coverage, you'll pass on that benefit or some of that benefit to your heirs. And that can be
Mm-hmm.
a very tax efficient way to do that as well. So
Right.
moving along, one of the things that we always talk about with our clients is making sure that all their assets and properties are properly placed and titled. This
Right.
has to do with IRAs. Do we have the right beneficiaries? You want to make sure that you're going through that with your advisor to discuss, do I have the right beneficiaries according to my wishes and my estate plans? And speaking of estate plans, number 11, are those estate planning documents up to date?
Mm-hmm.
We run into people all the time that either in the state of Texas, there's a stat that's thrown out there almost every year, and it's about 75% of all Texans will die without a will.
Wow.
So meaning they die intestate. And the state of Texas will provide you a will after you're gone, but it's probably not going to be what you wanted. So you need to have a regular review of your estate planning documents. That includes a will, that includes the medical power of attorney, advanced medical directives, all the different things, HIPAA release, all the things that are so important so that your final years are pleasant ones. And that brings us to number 12. Does your client need a trust? Now, we have a number of listeners, and one of our attorneys that we use will probably call in and text me about my comments here. But do you need a trust? Trust can be beneficial to some people in certain situations. And you need to talk with someone, your financial advisor or your attorney, about that to see if you do. Not everybody needs a trust, but they do make it such that they can cause the probate to go away or be limited. The example of a trust that I sometimes use is and not to pick on Michael Dell, but if Michael Dell's driving home today from Dell and he's killed in a car wreck, we knocked on wood. We don't want that to happen, of course. But will Dell Computers shut down? The answer is no, right? Dell Computer is like a corporation, and a trust is kind of like a corporation as well. Your estate or the care of you will continue to move on because you have that trust in place. So that's worth a conversation with your financial advisor and your attorneys. So the final thing, Jesse, is why is it important for clients to collect and organize all their documents in a digital format?
The things that happen in retirement probably are not going to be things that you plan for. So you need to have access to these things when they come up. And it's really convenient and secure to digitize them if you can. So if you have an online vault or somewhere on a cloud basis where you can store all these documents securely, we highly recommend that people do that.
Yeah, because nothing worse than being out on a vacation, your dream vacation. You having to go to the hospital, and you're incapacitated, and there's no one to give permission for your spouse to talk to the doctors. That advanced medical directive or a HIPAA release, so important. Store those things digitally in an encrypted vault. We have our financial planning software we use has that vault, so all our clients have access to that. So, folks, we're coming up on the end of the show. We've been talking about the 13 things you need to do to prepare for retirement. So much work to do. Always talk to a financial advisor before you make any decisions with anything. And Jesse, it's we've had the end of another program. Lord willing, we'll return next week, and we pray that your week is blessed. And if you have questions, give us a call. What's that number, Jesse?
254-282-0495.
All right. You've been listening to the Spend Life Well Show. Have a wonderful and blessed week.